Hey, Kyle here with whenthehouseyoulove.com. Today we're talking about 10 FHA tips and tricks. So FHA loans are fantastic loan options that are really flexible, especially if you have lower credit score or a lot of debt. But there's also a lot of tips that most even loan officers don't know. So we're going to walk through those today. So let's go ahead and dive right into this. So the first one is credit score brackets. So when you get your interest rates, primarily based on your credit score. And credit scores and interest rates don't correlate just one-to-one, right? It's not that if you have a 640, you have a better interest rate than a 639 necessarily just because that 1 point. It's only because we switched into a new bracket of credit. All right, so let's walk through some of these important ones. So it's important to remember that FHA has a minimum credit score of 500. All right, so if you have a 500 score to a 579, you need 10% down on an FHA loan. Now, the moment that we hit 580 is when we can do 3.5% as a minimum down payment on an FHA loan. Now, if we have a 620, this can often be an artificial minimum for lenders. And what this can mean is this is just an overlay. So basically, FHA makes their generic rules, and then lenders can set stricter rules on top of that depending on the loans that they want. And since 620 is the minimum for conventional loans, a lot of lenders just say 620 is going to be our minimum for FHA as well. And they go ahead and just bring or they raise that credit score minimum up. So if you see a lender and they're saying, hey, our minimum score for FHA is 620, just know you can shop with other lenders to be able to find somebody who can do lower than that. At 640, this is one of the most important brackets to hit. If we can get to a 640, we can get a much better credit score than if we even have a 639, that one difference in point. Again, it's not the one difference in point in credit score point, it's actual we went into a new bracket and that lowers our interest rate. Rates tend to get so much better when we hit into that 640 range. So when I'm talking with a client and they're at like a 634, normally what I say is like, let's see what we can do to raise those extra points to get you to a 640, because the difference between just a couple points in your credit score can literally save you thousands of dollars in interest on that loan. And then when we hit 680, this is where we start looking at saying conventional might be a better loan option. So conventional loans have a minimum of 620, but anywhere between 620 and 679, it seems like FHA actually tends to be a better option, even though it has higher mortgage insurance. It's usually because conventional loans tend to prefer higher credit scores and larger down payments, and so they can kind of penalize those lower credit score brackets. So when we get to 680, normally is when I start talking with clients about, hey, let's compare the cost difference between FHA and conventional short-term, medium-term, long-term to see which is going to be the better option for them. The second one is down payment assistance from family. So most people are familiar with like a down payment assistance program. Normally this is given through a local county program. All right, but you can actually get down payment assistance from your family, and I'll explain this here in a second. Just keep in mind, this isn't for everybody, right? Most people can't get a loan from their family. And this is either because, relationally, it's not always great to get a loan from Aunt Janet, right? That creates some weird conflict and rifts. I know I certainly probably wouldn't want to do that. And then also there's financial access, right? We don't all come from families that have the ability to lend us money or lend us money in a way that's going to have a good effect on the relationship in the future. But this is an option that a lot of people don't know about. So this can be secured or unsecured against the home. And this basically means the person giving the loan can choose to basically have a lien on the property as well. So if you sold it, they could get their money back legally if they wanted to in the event that something happened like that. Also, this has to be included in your debt to income ratio. So this means that let's say the loan is for $300 per month. If so, then that needs to be included in your debt to income ratio. And that can limit how much you can afford. So you could afford this, $300 a month lowers the max loan amount that you can get. So if you are using this, you're getting a loan from a family member, make sure you talk to your lender about this so they can include whatever that monthly payment is going to be in there. It's probably not going to be that high. It's probably not going to be $300 per month. Depends on the terms that you set up with whoever's giving you that money. Also, it cannot exceed 100% of the loan to value ratio. So this basically means if you're doing 3.5% down on an FHA loan, your family member can't give you 5% in addition. Like they can't give you the 3.5% and then all the way up to 5%. They can't give you a loan for greater than what the down payment amount is going to be. So effectively what we're saying here is you can get a loan for the down payment, but for closing costs, you need a gift. All right, you can't get a loan for the closing costs. It's a little tricky there. And also, a family member can borrow this. This is a little strange because normally we can't go get an FHA loan and borrow money ourselves for the down payment or closing costs, but a family member can. All right, so Aunt Janet could go take out a loan wherever she wants to get it from and then loan that money to us. And I don't actually have an Aunt Janet that I know of. If I do, I'm sorry. But that's an option. They can borrow it if they want to, or it can come out of their own funds. It's really up to however you want to structure that. All right, then number 3 is a repair escrow. Repair escrows are interesting, little known, helpful things about FHA loans. So basically what ends up happening, you get any loan, there's an appraisal that needs to happen. And FHA appraisals can be a little bit more strict than other loans like a conventional loan, especially when it comes to some of these little nitpicky things like chipping or peeling paint, or maybe no handrails on a staircase, something like that. And so basically, repair escrow allows you to take appraiser-required repairs and complete them after closing. Normally, things like that have to be fixed before you close on the loan, and this can delay the loan process if there's something in the middle that's keeping those repairs from happening. So there's a $5,000 max here, and it's for weather-related or other extenuating circumstances. So just as an example, my brother's a realtor. He was working with a buyer who ran into a situation where the home he was buying, the appraiser flagged it for chipping paint on the exterior, and it was like raining nonstop all week. They needed to close within that, the next 10 days. And so they did a repair escrow to basically allow that to be completed after closing. So there's an inspection that has to check that the repairs were completed, but they could close with the chipping, peeling paint, then have it fixed after closing. So it can help you shorten that timeline if you're running into some of those issues there. It's a little bit of a headache to go through, but it is an option that you have available if you need it. Number 4 is FHA's $100 down RIO program. So this is only for real estate owned properties by HUD, and you can find these on the HUD home store. I'll have a link in the description for this, but basically, there's no gimmicks to this program. Instead of having a 3.5% down payment, HUD basically says, hey, we have all these foreclosures. If you're looking to live in this home and it's on our website, we'll let you do this for $100 down. Now, not all lenders will do this program, but a majority will. You might have to shop around to find one that can be helpful there with you. And they can be really tough to find because not all homes are available in that capacity. So you'll find a list of those homes on the HUD home store there. Now, another program offered by HUD is the Good Neighbor Next Door program. And this is even more difficult to find homes that qualify for this, even more so than the $100 down. There's usually only a few in each state. Sometimes when I look, there's like none in a state, or there might be 1 or 2. So it can be really difficult to find these. But basically, this allows you to do $100 down. And this is the huge part. It's a 50% discount on the home. So if the home was $300,000, it would normally be listed for. If you qualify for the Good Neighbor Next Door program, you can get it for literally $150,000. Okay, it's wild, and $100 down, which is just incredible. So basically, the restrictions here are: 1, you have to be able to find a home that exists like that. Again, there's only maybe 1 to a couple in each state. You have to live there for 3+ years, and it's only for law enforcement officers, pre-K to 12th grade teachers, firefighters, and EMTs. Now, normally when I talk about this program, people tend to ask like, what about nurses or doctors? Do they qualify? And right now, that's not really in the guidelines. So these are going to be the ones that mainly qualify. Underwriters don't tend to look at things outside of that. Okay, so number 6 is disability social security income. So a lot of people ask, hey, I'm disabled or I'm retired. Can I get a loan? Answer is 100% yes. You don't have to be employed necessarily to get a loan. You just need to show consistent income. And normally lenders see this through having consistent employment. That normally shows us consistent income. However, if you're retired or on disability, then this changes because you most likely don't have employment, or maybe employment is only a portion of the income that you have coming in. So I actually really, really like when loans have this type of income, fixed income, because it's really, really easy to underwrite. It's really easy to see what somebody qualifies for with, right? Because a lot of people work hourly, or they might work with overtime or bonuses, and it can get a little bit tricky to figure out what somebody's monthly income is. But fixed income is fixed. It's always the same, so it's really easy to qualify with. The big issue here that a lot of people have with disability or Social Security income, any type of fixed income, is their debt to income can be an issue. Because usually when we're on a fixed income, it tends to be on the lower end, right? So if we only make $2,000 a month from Social Security, then it's difficult for us to take on a large housing payment with only $2,000 per month. Now, a benefit is we can actually gross up this income. All right, so since most fixed income is tax-free, grossing up allows a lender to look at what would be the gross if it was taxed. So if we actually make, let's say, $2,000 a month in Social Security income, we can actually multiply that times 1.5%. I'm sorry, 1.25%, and that would give us a qualifying monthly income of $2,500 per month. Okay, so that's what we could use for our affordability. All right. Number 7 is DACA is now allowed. So in January 19th, FHA basically said, hey, we're going to make it extremely clear. DACA is now allowed. It used to be only for conventional loans, and FHA was always kind of like, never gave a clear answer. They always kind of skirting around the question when people ask, can we use DACA with FHA? And they finally said, it's effective. You can now use, or DACA recipients can now use FHA loans, and same rules apply to DACA recipients as everyone else. So credit requirements, income requirements, employment requirements, all of that is going to be the same for everybody getting those loans. Number 8 is you can get a gifted commission. So this, again, is one that's going to be not applicable to everyone. All right, so this is mainly for if you have a family member who's a licensed agent, they can gift part or all of their commission to your down payment or closing costs. So this is helpful if you have a friend and they're saying, hey, we'd love to help you out. We'd love to help you buy the home, or maybe they're representing the seller too, whatever that looks like. And they say, hey, we want to give you a gift from the commission. That's perfectly fine. Or if you're an agent yourself, if you're a licensed agent, you can use your own personal commission towards your down payment, right? And most of the time, you're going to be running into a commission of somewhere around 3% gross. So you probably have other fees to a broker, whomever you need to pay those to, but you can use that 3% or 2% or whatever to your down payment or closing costs, right? So if it's 3%, you only need to come up with another 0.5% for that 3.5% total down payment. Now, this last one here, this is the most powerful strategy to keep in mind with FHA. And this is what I like to call the bridge strategy. So to me, an FHA loan should not be a long-term loan. We should not be carrying a loan for 30 years. Ideally, FHA loan, we should be holding on to it as short of a time as possible. I like to think of it as a bridge to get us into cheaper debt. Because anytime we have debt, the whole purpose of us refinancing is to get cheaper debt, right? Because money can sometimes become cheaper over time because rates lower or costs change, and we want to refinance into lower cost debt if we're going to be holding it for decades at a time, right? So usually there are things that we can work on. We had to get an FHA loan now because of certain reasons, but there are things we can work on to get into a cheaper loan like a conventional loan. Okay, so let's run through a quick example here. So let's say right now we have a 584 credit score. So right off the bat, we can't qualify conventional because conventional has a minimum of 620. So we're saying, well, we still want to buy a home, even though we have a 580 credit score. Working on this is going to take us too long to be able to qualify conventional. We're going to have to be renting for another couple of years. We're going to miss out on, we're not going to collect any equity. We're not going to collect any appreciation. And we don't want to have to keep renting and living under our landlord's rules about what we can and can't do. So we still want to buy a home. So we use an FHA loan because an FHA loan isn't bad. It's not a bad loan at all. It's just one that is best used if we maybe have it for a shorter time period than stretching it out over 30 years. Okay, so we have a 584 score, and because of that lower score, we're going to have a higher rate, and we have to pay 2 types of mortgage insurance. So FHA has their upfront mortgage insurance and the monthly mortgage insurance, and those are going to stay on for the life of the loan unless we put 10% down, and then it's going to fall off after 11 years. So even 11 years worth of mortgage insurance is a lot. Compared to conventional, that will fall off normally when we hit about 20% equity in the home. So we know that right now our credit score is low because we have a lot of debt. So what we would do is we would say, hey, this is where we're at right now. We're going to get this loan, but then we're going to create an exit strategy. I know that right now what I need to do is I need to work on paying off debt. So then with maybe 2 years time, 3 years time, 5 years time, I can refinance into a conventional loan. So we've been working on paying down our debt. Fast forward 2 years. Now we have a 735 score. We can refinance into a conventional loan, get a lower rate and lower mortgage insurance, and possibly remove the mortgage insurance depending on appreciation, the equity that we put in as well, and possibly any renovations that we've done to the home to get us up to that 20% equity so we can completely remove mortgage insurance altogether. So it's a good question to ask when you do get an FHA loan, or if you're going down the road to say, why are we in an FHA loan to begin with? Why do I need to get an FHA loan to start with? That's going to lead us down into our plan of saying, well, I know over the next X amount of years, this is what I need to do to refinance into a conventional, and talk to your loan officer about this, saying, hey, can you explain why we need to go FHA if that's the only one we qualify for? And then what are the things that we need to do to be able to refinance to conventional, and about how long do you think that that would take for us to get there? And then number 10 is ask your lender, what can I do to qualify better? Now, don't pass this over, because especially if you're already qualified, you might be thinking, well, I already qualified, who cares? But loan officers are used to, most of the time, taking an application, qualifying somebody for a specific loan program, telling them the maximum loan that they can get qualified for, give them quotes, and that's it. But often, there's a bigger discussion in here that we can have about what can I do to qualify just a little bit better, because sometimes it just means maybe we need to pay down a specific card, and that's going to increase our credit score by 20 points. That puts us in a new bracket. That lowers our interest rate, or that lets us qualify conventional, or there's certain things that we can do to pay off other types of debt, or structure the loan differently so we can qualify for a different type of loan, or save money with the current loan that we have. And so just asking that question, what can I do with my credit, with my income, with my employment, with the money I have in my bank account to qualify just a little bit better, just to save a little bit more money? Is that something that is possible for me? And that's going to set you up for a much better plan and strategy moving forward. And that's exactly why I have this video for you on how to choose the best mortgage lender. So if you click on this video over here, it's going to walk you through how to choose one that's going to be helpful for you, so you can walk through getting an FHA loan or conventional, USDA, VA, whatever loan you choose, and save the most money possible in the future.